Podcast title: AI Crash, Chips Collapse, and Gold. The Hidden Connection. Intro. Host voice: calm and authoritative. Welcome to Macro Deep Dive, where we decode the forces shaping markets. Today's episode tackles a fascinating question. What happens to gold prices, both physical and paper, if the AI boom turns into a bust, hyperscalers slash chip orders, and the semiconductor sector collapses? It's a scenario that sounds far-fetched, but history and market mechanics tell us it's worth exploring. So grab your coffee, because we're going deep. Segment 1. The Trigger: AI Crash and Chip Sector Fallout. Let's start with the domino effect. AI has been the engine behind hyperscaler spending. Think massive data centers, GPUs, and memory chips. In 2025, hyperscaler CapEx was projected at over $315 billion, largely driven by AI infrastructure. Now imagine this. AI ROI disappoints, valuations implode, and hyperscalers hit the brakes. CapEx freezes. Semiconductor demand plunges. Suddenly, the chip sector, already cyclical, faces a brutal contraction. Morningstar and other analysts have warned that the chip boom is peaking. If AI spending slows, the unwind could be sharp. And when tech-heavy indices start bleeding, systemic risk rises. Segment 2. How does this hit gold? Gold is supposed to be a safe haven, right? But here's the twist. In the first phase of a tech-driven crash, gold often falls. Why? Liquidity. When portfolios face margin calls, traders sell what's liquid, and gold futures are among the most liquid assets. We saw this in January 2025, when Nvidia plunged 17%. Gold dropped $170 before rebounding. Correlation matters too. Recently, gold and tech have shown an unusual plus 0.78 correlation. When that breaks, expect volatility. So, paper gold, futures, and ETFs takes the hit first. Meanwhile, physical gold behaves differently. Premiums spike as investors seek tangible assets. Central banks and retail buyers rush in, widening spreads by 3 to 5%. Industrial demand for gold and electronics? It dips, but that's marginal compared to investment flows. Segment 3. Liquidity dynamics and policy response. This is where macro mechanics kick in. Liquidity stress, repo rates, credit spreads, forces selling across risk assets. Gold gets caught in the crossfire. But history shows the rebound can be powerful. In 2008, gold fell 30% during the panic, then surged 166% over 3 years. In March 2020, gold dropped 12% before hitting record highs within months. The pattern? Initial shock, then policy pivot. When the Fed steps in with liquidity backstops, gold flips from defense to offense. Segment 4. Hyperscaler CapEx freeze, secondary effects. Cutting chip orders doesn't just hurt semiconductors. It ripples through commodities, copper, rare earths, and shifts investor psychology. AI crash plus CapEx freeze equals stagflation risk. Low growth, sticky inflation. Historically, that's bullish for gold after the liquidity storm passes. Segment 5. Scenario breakdown. Here's the roadmap. Initial shock. Paper gold down 5 to 12%. Physical premiums up 5%. Policy pivot. Recovery to pre-crash levels as liquidity injections kick in. Medium term. Gold rallies 15 to 25% as stagflation fears and reserve diversification dominate. Segment 6. Strategic positioning. So how do you play it? Short term. Hedge paper exposure. Expect whipsaws. Medium term. Accumulate physical gold on dips. Watch hyperscaler CapEx guidance, GPU order trends, and Fed signals. They're your leading indicators. Check out our show notes for our Patreon, where we sell scripts for TradingView to help you time your entries and exit successfully, and then add it in our other platforms we publish on as a syndicated podcast through our SS.com, and where we have our link to our store where our sponsor brands are hosted. Thanks. Closing. An AI crash that derails hyperscaler spending will first hurt gold via liquidity-driven selling, then catapult it higher as systemic trust erodes and policy pivots to stimulus. That's the paradox. Gold suffers in the panic, then shines in the aftermath. Thanks for tuning in to Macro Deep Dive. If you found this valuable, share it, subscribe, and stay ahead of the curve.